Supply and demand. It is the essence of the financial markets, and it's essentially what we try and build our strategies around to try and profit from. But how do the institutions affect this dynamic? And how can you better understand it? Well, as part of Pepperstone's Master the Market series, we look at when and how the institutions place orders in markets. Take it away, Ty and Tom.
All right, welcome everybody. Today we're covering a very important one that I'm sure everybody loves out there, which is how do large institutions actually place orders? How do big banks actually get into market positions? And do we need to change our thought process when it comes to big bank institutions placing orders? If we're a scalper or a day trader, can we take advantage of this type of entry? So we'll be discussing here basically how markets actually move from price to price, how institutions actually enter positions, and then of course, naked price action trade sequences. How can they help us potentially understand markets better? And I think this is the thing with day trading and scalping. We really need to have these naked price action trading sequences. So Ty, when it comes to understanding where banks place orders, was this something that you knew straight away in markets, or do you think it was something that we learnt over time?
Absolutely not at the start. I think we had all sorts of problems really identifying these areas, and we were certainly ones, very early on to be falling into all of the traps of actually not understanding where these orders are placed. And
Yep.
And look, a lot of it's nothing to be ashamed of either. I think most traders, when they first start out, if they haven't been educated correctly in the markets, are going to make these same mistakes because it's very, very it's very hard not to be honest, because it's not obvious in the first instance if it's not explained properly. I wish, Tom, that we had webinars and videos like these actually showing us how to do it. It would have saved us a lot of money and certainly a lot of account blowing up, because it's a very, very important concept. Because look, let's face it, as many retail traders would probably understand, or we make up a very, very small part of the market really. Like when we're looking about how volume works and how markets really move, we can only participate. We can't move markets as retail traders. So understanding where the big orders are placed and how they work is extraordinarily important, because it allows us to participate rather than try and move. We don't need to move the market. We just want to participate in the movement, don't we?
Yeah, we just need to participate in the right area of the movement. And I often hear big investors and billion-dollar fund managers talk about, I just want 2/3 of the move. Just give me 2/3 of the move. That's all 100%. I'm happy with. It's usually, I think that's usually how we slice the pie. So how do we catch a 2/3 of the move? Well, again, we need to understand where periods of accumulation are created and periods of distribution are created. And more importantly, what actually changes a trend? What actually begins a trend? So today we'll discuss first time frame changes of trend, one of my favorite topics. So markets usually look like this, Ty. They have an accumulation, they break out, they go into what we call the markup phase or the 2/3 phase, and then often they'll enter into distribution or what we call excess. And most modern day trade analysis techniques look something like this in terms of theory. But how do big traders actually place trades? Well, this comes down to, when you think about a big trader, what are they? They are a huge institution with billions of dollars to get into that market. If they're going to trade the Australian US dollar, for example, they're going to need to add positions over time. They can't just go, $1 billion into the market. It's just not going to accept it straight away, or even more. Maybe they have to add $10, $15 billion position. They have to do it over time. And this leads to a lot of manipulation, doesn't it, Ty, in these markets?
Yeah, absolutely it does. And people think that, look, a bank is not going to go on and place an order at a particular price and throw the entire ball and chain at it and say, this is the price that we're going to get it at. It can't work that way. That's going to cause all sorts of blocks in the market. It's going to have, it's going to force lines similar to bank intervention. If that happens, you're going to have bank interventions everywhere where price can't get past a particular point because it's accumulating a particular position. That can't happen that way. But there is a fair price that they're after. And what they do, we can see here that we've got three different levels of where, or what would be acceptable. We've got the three different levels of what a fair price would be, what a really attractive price would be, and what an acceptable price would be. And this is why banks have big traders working for them, because it's not as simple as actually just placing that one trade. You hear all the time that banks have big amounts of traders doing all the trading volume. If they were placing only one trade, they'd only need one trader, right? So that's not realistic. That's why they've got so many different traders working for them, placing these smaller orders, or what we would consider big orders, but obviously small orders for the bank, to build a position. And this is exactly what they're doing. We can see this in this diagram here.
Yeah, so as the price approaches 72, they might think that's an okay, acceptable price, as you mentioned, and they will begin a purchasing spree at a lesser amount. As it enters into fair price, they'll increase the amount, and if it enters into cheap price or a very good price, they will usually accept even more of those orders, so they'll place even more of them. And why this is such an important sequence is when you think about it, this is often what happens. As it goes back above the acceptable rate, they stop purchasing. And therefore, people that were day trading and getting involved in that trade, they might start to sell their positions, and it drops back down into the fair price, the acceptable price, and possibly the cheap price. And what this does is it builds that structure. And most people that are probably watching this video right now don't really think of markets this way. They don't think of actually how these big institutions actually enter into the markets. And what you're looking for often at the bottom of these cheap areas is wicks. And when you see wicks, you'll notice they hold the key. Wicks hold excitement of the market. So, often when we learn technical analysis for the first time, Ty, we learn something about a pin bar or a hammer. Yeah, it's a great entry criteria, but in the right area, it's more powerful. And that's why we look for price like this. And we start to understand that when we see sideways market action, or channels, as many people call them, or demand or accumulation, doesn't really matter. Effectively, what we're looking at actually is a large institution entering positions in a methodical way at different prices with those little snippet areas. And it's such a great way of simplifying price. And I got taught this, I guess you would say, from a pretty big fund manager. And they basically said, this is the way that we would enter in. And it's a great way, I think, of conceptualizing a fairly complex building strategy over time.
Yeah, most definitely. And I think understanding those candles as well, that they are very, very relevant in those areas of accumulation, but really in the middle of nowhere, they're really not worth anywhere near as much weight. So I think it's very, very important to understand these areas, although you might say, well, what do we do with them? Understanding the candles that are happening in those areas and the price action, which is what we're talking about, is very, very important, because price action in the right area is extraordinarily useful to actually place a trade. Whereas, it can be a little bit less important if it's in the middle of nowhere, really. And we do see that sometimes.
Yeah, so people like Wyckoff kind of came up with schematics or systems around these accumulation and distribution areas. He said that to build a position often takes kind of spikes of zones to effectively trap people into the wrong positions, and then they build liquidity, and then of course they push off in a direction. Remember, it's your job as a trader to recognize these traps, and therefore when it pushes off into the right direction, take that 2/3 movement. That is usually the way you're looking at it. So we mentioned that there are price action sequences, and these are the ones that I think most people make mistakes on. Here's a basic trend. And the trend's coming down. We've got a low, we've got a high, we've got a lower low, we've got a higher high, we've got a lower high, we've got a lower low, lower high, lower low, and then suddenly we make a higher high. Now, when this happens, we break the previous peak, and effectively we change the trend. This is what we call a first time frame change of trend. And most people don't look at it this way and don't understand it in the markets. It's such an important aspect of naked chart analysis and price action analysis. If we go over and we think about it, if a market structure looks something like this, and then it breaches through, what it's done is it's in essence broken through the orders that were placed here that got pressured down. And therefore, it's ready to move to what I call the next level of equilibrium. This is what we call a first time frame change of trend. And around this price, markets should remain bullish, and pullbacks would usually be met by bull demand. And it's something that usually is the first way that price action does change. A little bit of an example here, Tyrone, is this one, which gets a lot of people caught off guard. We often call this the lightning bolt method. That is a low, a higher low, and then a higher high. And it is a very good way of looking at swing trade in particular and investment entry levels. But when we're dealing with scalping and day trading, we've also got to pay attention to the left-hand side. We need to take out that previous peak. Once we've done that, we've taken out the orders that were placed there that lead to a sell, and we effectively can move to the next level of equilibrium, which in this case would most likely be that previous peak. So the point from here to here becomes more likely. And this is where we get back to that 2/3 analysis. So such an important concept, understanding naked price action sequences. We've got some here on the charts, and that's something that I would always break down for scalpers and day traders in particular.
Yeah, lightning bolts are extraordinarily important, but understanding where they are and why they're forming is just as important. And like you say, if we're not taking out the previous peak or the previous trough, is it really a lightning bolt? People can be very, very creative, Tom, when they're drawing the lightning bolts that we talk about. So it's very important to make sure that they are actually breaking the right zones, because it's one of the most important parts of actually price action, especially the naked price action that we're talking about. When you're looking at naked charts, it's extraordinarily important to understand the lightning bolt effect, because the higher highs and higher lows and lower highs and lower lows are the real benchmark for actual price movement. And the levels that they're taking out, being the previous highs or the previous lows, are really the clue that it's giving us that the momentum has truly shifted, and that 2/3 movement that we're trying to get involved in is actually in play.